بسم الله الرحمن الرحيم، والصلاة والسلام على أشرف المرسلين. أعزائي طلاب الفرقة الثانية بشعبة اللغة الإنجليزية، السلام عليكم ورحمة الله وبركاته. Today we are going to start a new chapter in our intermediate accounting course, chapter 23, Statement of Cash Flows. So what about our learning objectives from this chapter? After studying this chapter, you should be able to: first, you have to describe the usefulness and format of the statement of cash flows. Second, you can prepare a statement of cash flows. Third, you can contrast the direct and the indirect methods of calculating net cash flow from operating activities. Fourth, you can discuss special problems in preparing a statement of cash flows. Fifth, explain the use of a worksheet in preparing a statement of cash flows. Let's start with the first learning objective, concerning describing the usefulness and format of the statement of cash flows. Accounting aims at providing users with useful information to help them in making decisions. This objective is achieved by financial reporting, which contains mainly financial statements, additional notes, auditor report, management discussion and analysis plus voluntary disclosure. Financial statements includes income statement, statement of returned earnings, and balance sheet. And as you know, accounting is based on accrual basis, which records revenues when earned and expenses when incurred, regardless of cash collection or cash payment. Therefore, the net income is not informative about the cash position of the firm, about cash payments and cash received, and cash transactions of the firm. However, you can find in the balance sheet an asset called cash, which tells you the amount of cash handled by the firm at a certain period of time, at a certain point of time. But it tells nothing about how this cash is achieved. Therefore, we have to prepare another statement, which is a statement of cash flow. Cash flow means cash in and cash out, cash collections and cash payment. This statement tries to complete the objective of financial accounting of providing users by information. So this statement has two purposes, one primary purpose and one secondary purpose. The primary purpose is to provide information about the company cash receipts, cash collections, and cash payments during a period, during interval of time. The secondary purpose is to provide cash basis information, not accrual basis information as other statements, but a cash basis information about the company's operating, investing, and financing activities. And as we will know later, this statement divides the firm activities and operation into three main categories. The first one is the operating activities, the second is investing activities, and third, financing activities. Statement of cash flows provides information to help users, like investors and creditors and others, to assess the following. First, entity's ability to generate future cash flows. As we know, a primary objective of financial reporting is to provide information with which we can predict the amount, timing, and uncertainty of future cash flows. This can be done efficient and effective using the information from cash flow statement by examining the relationships between items such as sales, as we know from income statement, and net cash flow from operating activities. Second, we can assess also the entity's ability to pay dividends and meet obligation. With adequate cash, with a sufficient cash, a company can pay employees, can settle debts, can pay out dividends, or acquire equipment. That cannot be done without adequate cash. This information about cash is expressed in the cash flow statement. Third, it helps users to assess reasons for the difference between net income and net cash flow from operating activities. Net income in the income statement is determined on the basis of accrual basis, which induces companies to make estimates to arrive at it, such as estimating useful lives and residual values when calculating the annual depreciation using straight line depreciation method. Such is not the case with cash. Fourth, users can also assess cash and non-cash investing and financing transactions during the period. And later we will know what is meant by investing activities and financing activities in more details. Classification of cash flows. Statement of cash flows classifies cash receipts and cash payments of the firm into three main categories. The first one is operating activities, which involves the cash effects of transactions that enter into the determination of net income, such as cash receipts from sales of goods and services, and cash payments to suppliers, cash payments to employees, cash payments for acquisition of inventory and expenses. Second category is investing activities, which generally involve long-term assets and includes making and collection of loans, making loans to other entities, and collection of the principal of the loans. Also, acquiring and disposing of investment and productive long-term assets. Third category, including financing activities, which involves liability and stockholders' equity items, and obtaining a cash from creditors and repaying the amounts borrowed, also obtaining capital from owners and providing them with a return on and return of their investment. In the following slide, we are going to show a more detailed presentation of this classification. Here we show the first category, which is income statement items covered by operating activities, and we have two sources of cash effects. The first source is cash inflows. The second is cash outflows. In cash inflows, you can see cash inflow, cash collections from sales of goods and services, and from return on loans only interest received, and return on equity securities, dividends received by the firm. They are the two major sources of operating cash inflow. Also, we see 5 sources of cash outflow. The first, cash outflow to suppliers for the purchase of inventory. Also, cash outflow, cash payments to employees, cash payment to government for taxes, cash payment to lenders for interest, and to other expenses. The second category, investing activities, which generally includes long-term assets items. We also have cash inflows and cash outflows. Cash inflows from sale of property, plant and equipment, from sale of fixed assets, from sale of long-term assets. Also from sale of debt or equity securities of other entities, or from collection of principal on loans to other entities. And also we have cash outflow from purchase of property, plant and equipment, purchase of debt or equity securities, or making loan to other entities. By the way, you can see that the three sources of cash inflow are the same as the sources of cash outflow, but here the direction of cash, sale or collection, is inflow, purchase or lending is outflow. The third category is financing activities, which covers long-term liability and equity items. Also, we can classify it into cash inflows and cash outflows. Cash inflows have two sources, which are sale of equity securities, which are belonging to the same firm, or from issuance of debt, from issuance of bonds and notes, the other source of finance. These two sources provide firm with cash, so they are considered a cash inflows. Cash outflow is the opposite. We have to stockholders as a dividends. The firm pays dividends, do not receive dividends, pays dividends, or to redeem long-term debt or reacquire capital stock. So we have three categories of cash flows. The first category is operating activities, is the most important one. Also, we have investing and financing categories. Now let's concentrate on how does cash flow statement concentrates on cash. Actually, cash flow statement concentrates on cash and cash equivalents. As the basis recommended by the FASB, by Financial Accounting Standards Board, for the statement of cash flow is actually cash and cash equivalents. So what is meant by cash equivalents? Cash equivalents are items like cash. They are short-term, highly liquid investments that are posts that have two major criteria. The first one, readily convertible to known amounts of cash, and so near their maturity that they present insignificant risk of changes in interest rate. So, cash equivalent should have the two criteria. The first one, readily convertible, the second, near the maturity. Generally, only investments with original maturities of 3 months or less qualify under this definition. How can we prepare the statement of cash flow? What is the format of a statement of cash flow? In the presentation of cash flow, firms can use the direct method or indirect method of preparing cash flow statement. But actually, direct method or indirect method relating only to operating activities. So when you prepare the operating activities section, you can use the direct method or indirect method, and we will later show more details about how to prepare the cash flow statement under both methods. Also, you can prepare the investing activities and financing activities, and they do not differ under the two methods. To report inflows and outflows from investing and financing activities. So we have three categories
presented separately. Operating activities under either direct or indirect method, also investing activities and financing activities. The three sections are prepared separately. And this illustration shows how do we prepare the cash flow statement. Looks like other statements. We start by the firm name, then the statement name, then the period cover. These are the three items covered in the head of the statement. Company name, then the statement of cash flow, then for the period ended, let's say 2020. And we start by cash flow from operating activities. Cash flow from operating activities, and end with cash at the end of the period. As we see here, we start with net income. Net income, but this net income is prepared according to accrual basis. Accrual basis, which is subject to critical of users. So we have to reconcile it, to adjust it to cash basis in the operating section. So we start with net income and adjust it to cash flow provided using cash flow provided or used by operating activities. So there we have a list of items which includes cash inflows and cash outflows of operating activities, to end up with the net cash provided or used by operating activities. Also, we have cash flow from investing activities. We have a list of cash items, cash inflows and cash outflows, to reach the net cash provided or used by investing activities. The third section is cash flow from financing activities. Also, we have a list of items to end up with net cash provided or used by financing activities. So we have net increase or decrease in cash during this period. Net increase or decrease in cash during this period resulting from the three categories: operating, investing, and financing activities. Then adjust the cash at the beginning of the period by the increase or decrease to end up with the cash at the end of the period. So by this illustration, you can now know that cash flow statement explains how cash changes from one period to another. What are the sources of cash changes from one period to another? As cash at balance sheet, you find a cash, say 10,000 at the end of 2019, but at the end of 2020 it becomes 12,000. What is the source of this 2,000 increase? Cash flow statement explains the sources of 2,000 increase in cash by classifying the company operations into three categories and gives indication what are the source of the 2,000 increase in cash. Now we start the second learning objective concerning the preparation of statement of cash flows. How can we prepare the statement of cash flow? First, we have to know the sources of information, the information required to prepare the cash flow statement. First, we have three sources. First source is comparative balance sheets. Comparative balance sheet means a balance sheet of two consecutive periods. For example, the balance sheet of 2019 and 2020. These two balance sheets provide the amount of the changes in assets, liabilities, and equities from the beginning to the end of the period. So we have to start with a comparative balance sheet to know how assets, liabilities, and owner's equity change. Second source is current income statement data. Income statement helps you to determine the amount of cash provided by or cash used by operations during the period. Third source is selected transaction data, which provide additional detailed information needed to determine how the company provided or used cash during the period. These are the three major sources of information. So you should have a comparative balance sheets, a current income statement data, and selected transaction data. And we have to follow three major steps to prepare the cash flow statement. First step is to determine change in cash, how cash changes from period to another. The second step is to determine net cash flow from operating activities using either direct method or indirect method. Third step, determine net cash flow from investing and financing activities. So we have three sources and three steps to prepare the statement of cash flow. Let's start with an example. Tax consultant started on January 1st, 2019. The firm starts business on January 1st, 2019, when it issued 60,000 shares of $1 par value common stock for $60,000 cash. The company rented its office space, furniture, and equipment and performed tax consulting services throughout the first year. The comparative balance sheet at the beginning and end of the year 2019 appear in the following slide. The next slide also shows the income statement and additional information for tax consultant. Here we find the first source of information, which is comparative balance sheet. We have the balance sheet at January 1st, 2019, balance sheet at the early start of the firm, where the firm is not established yet, and the balance sheet at December 31st, 2019, at the end of the year. We have assets includes cash. The company in the year was $49,000, while it start by zero. So we have increase in cash, the last column, increase in cash by $49,000. Also we have accounts receivable, $36,000, while the company starts the year without any account receivable. So we have also $36,000 increase in accounts receivable. Total assets is $85,000. Also we have liabilities and stockholders equity. We have accounts payable $5,000 compared to zero, so accounts payable increased by $5,000. Also we have common stock $1 bar $60,000 compared to zero, so we have $60,000 increase. Returned earnings $20,000 compared to zero, so we have $20,000 increase in returned earnings. So the comparative balance sheet helps us to know the amount of changes in assets, liabilities, and equities, which are indicated in the last column, a change, increase, and decrease. Also, you are provided with the income statement, current income statement for the current year, for the year ended December 31, 2019. Income statement helps to determine the amount of cash provided by or used by operation during the period. Here we find that revenues of the firm is $125,000 and we have operating expenses $85,000. So net income before tax is $40,000 and income tax expense is $6,000 and net income is $34,000. Also, we are provided with additional information. Examination of selected data, the last row, examination of selected data indicates that a dividend of $14,000 was declared and paid during the year. This indicates why there is still a retained earning of $20,000. The firm earned a net income of $34,000, paid $14,000 as a dividends, so the company retained $20,000 as retained earnings. First step is determine the change in cash. You can find cash at December 31, 2019, $49,000 compared to cash at January 1st, 2019 is zero, so cash increased by $49,000. Second step, we have to determine the net cash flow from operating activities. Company must determine revenues and expenses on a cash basis. We have to eliminate the effects of income statement transactions that do not result in increase or decrease in cash, which means convert net income to net cash flow from operating activities through either a direct method or indirect method, the two methods for preparing the operating activities section in cash flow statement. Net income is determined as a result of deducting incurred expenses from recognized revenue. Recognized revenue and incurred expenses are determined on accrual basis. So net income is the result of accrual basis. How can we convert net income into net cash flow from operating activities? This can be easily done by just eliminating non-cash revenues, any recognized revenue not collected in cash, also eliminating non-cash expenses, any incurred expense not paid in cash. So we can adjust net income to net cash flow from operating activities. In our example, to determine the change in cash flow resulting from operating activities, we have to start with analyzing accounting receivable account. You notice from the balance sheet that account receivable increased from January 1st, 2019 to December 31, 2019 by 36,000. Increased from 0 to 36,000. So during the year, the account receivable increased by 36,000. What does this increase means? As you see in the income statement, we have revenues of $125,000. If all these revenues were in cash, so there is no need to increase in account receivable. But as account receivable increase, this means we have a non-cash sales. We have sales on a credit. We have a sales that resulted in increase in account receivable. Thus, when the account receivable balance increases, cash receipts are lower than revenue earned under the accrual basis. Therefore, the increase in accounts receivable is subtracted from net income to arrive at net cash provided by operating activities. As here we see, we start with net income as shown in income statement, $34,000. and we adjust it by subtracting the increase in account receivable, $36,000. Also, we add the increase in accounts payable, as we will see later. We also have to analyze the accounts payable, as increase in accounts payable means that expenses on an accrual basis exceeds those on a cash basis. Therefore, if accounts payable increase, this means we have to add the increase to net income to reconcile it and reach cash flow provided by operating activities. And if accounts payable decrease, this means we have to subtract the decrease. In our example, accounts payable increased by $5,000. If you go back to the liabilities section in the balance sheet, you notice that at the beginning of the year, the accounts payable has a zero balance, but at the end of the year, the accounts payable have a balance of $5,000. Therefore, accounts payable increased by $5,000. We have to add these $5,000 to net income to reconcile it, to adjust it to cash flow from operating activities. Let's go back to our example. We started with net income of $34,000 and subtracted the increase in account receivable, $36,000, and increase in accounts payable, $5,000. So the net adjustment is subtract $31,000. So starting with net income of $34,000 and subtracting net adjustment of $31,000, therefore net cash provided by operating activities will be $3,000. So $3,000 is the net cash provided by operating activities. What about cash provided by investing and financing activities? In the third step, we have to determine the net cash flow from investing and financing activities. Do not forget, you have three sources. The first source was a comparative balance sheet. Looking on the liabilities and the stockholders' equity, there are two remaining items that we did not consider in the operating activities: common stock and retained earnings. Let's see what happens to common stock. At the beginning of the year, the balance of common stock was zero, but at the end of the year, the balance of common stock was $60,000. Therefore, common stock increased by $60,000. Also, retained earnings at the beginning of the year has a zero balance, but at the end of the year, it has a $20,000 balance. So, also retained earning increased by $20,000. We have finished already the operating activities section. So let's go to investing and financing section. In our company, there is no investment activities. The company did not acquire a long-term assets or making a loans. But we have a financing section. In our example, financing section activities confined only to issuance of common stock. The issuance of common stock yields cash to the company, increases cash to the company, so we have to add $60,000. But the company also paid dividends to owners, to shareholders. From the additional information, we notice that the company declared and paid $14,000. This $14,000 represents cash outflow. So in the financing section, we find $60,000 added, also $14,000 subtracted as cash outflow. So the net cash provided by financing activities is $46,000. To end up with $49,000 as net increase in cash. Cash provided by operating activities is $3,000 plus cash provided by financing activities $46,000. Add them up to end up with net cash increase $49,000. And remember, cash beginning balance at January 1st, 2019 was zero, so cash at December 31, 2019 is $49,000. Let's remember again. Cash flow statement explains how cash balance change from one balance sheet to another, from a certain point of time to another. So it explains the change in cash balance between comparative balance sheets. We start with zero and end with $49,000. It explains from where these $49,000 has come to the firm. In the following slides, we present the information required to prepare the cash flow statement for year 2 and year 3 for the same firm. You are provided with the comparative balance sheet with the current income statement of year 2 and year 3 and additional information for each year. You can exercise yourself the preparation of operating activities under indirect method and financing and investment activities. Finally, we can summarize the indirect method adjustment to determine net cash flow from operating activities. We start with net income and make some additions and some deductions. You can see a summary of the addition required and deduction needed to reach net cash flow from operating activities. Thank you.